Time for the word on Wall Street. Top investors watching your money. Joining me now, Walser Wealth Management President Rebecca Walser and Michael Lee, strategy founder Michael Lee. Welcome, everybody. Mike, you've been here for an hour and 12 minutes. Let me start with you, Rebecca. Oil prices up this morning after sliding to a 7-month low yesterday on rate hike expectations. Where do you see oil prices headed here, Rebecca?
Well, Dagan, it's hard. We have demand destruction, obviously, at $120 a barrel earlier this year, now at 86 around that about. We have demand destruction, but we also have Biden releasing 160 million barrels from the strategic reserve, authorizing another 20 million barrels in July. So that obviously has brought the prices down substantially from the 5 to the 3.8. But OPEC is retaliating and taking away the very 100,000 barrels a day they gave Biden. They're taking that back in October. So we have a combination of demand destruction and obviously, these prices being too high for too long and people making other choices. So I think that we're going to have a problem. It's going to continue to be a balance between actual production and actual usage. And where is that going to be in this economy globally?
Right. And the Biden administration, based on reporting by the Wall Street Journal, has leased fewer acres for oil and gas drilling offshore and on federal land than any other administration in its early stages, dating back until the end of World War II. So higher, longer seems to be the strategy.
Yeah, Dagan, I mean, this is the lowest reserves we've had since 1985. And these are not the point of reserves. Reserves are for wartime. Reserves are for economic depression and bread lines. And we haven't really had a need. This use of reserves and releasing reserves to give the public a false sense of inflation control, is just not something that's maintainable. And it's not the use of the strategic petroleum reserves. So this is frustrating that this administration uses this kind of policy to control inflation instead of actually opening up oil and gas leases or reinstating oil and gas leases as we should be doing and becoming, again, energy independent as we were under the previous administration.
Yeah, James Freeman, he stepped out for a second, but he wrote a column that's in the Wall Street Journal. It was published yesterday, and he writes, the Biden administration seeks to wean the U.S. economy off fossil fuels. This will not be an easy ride for U.S. consumers or taxpayers. We'll talk about that as the morning moves on. But, Mike, let's talk housing. Goldman Sachs warning that the housing market downturn will worsen next year in 2023. This is the 30-year fixed-rate mortgage is now at 5.94%, the highest since mid-June. Mike, your take on the housing market. If you want a recession, you got it right here in housing.
Yeah, housing is a perfect leading indicator for recession. If you look at building permits, housing starts, home sales, and you look at the charts of all of them, they all look eerily similar in a straight line going down into a crater. So this is a combination of a multitude of factors, definitely interest rates going up, but also the run out of stimulus money and the economy just slowing dramatically. Energy, food costs, these things have taken a larger portion of the wallet share, and now your average 30-year mortgage payment has basically doubled year over year because interest rates have jumped so significantly. Goldman calls for a 7% 30-year mortgage at some point next year. I would dispute that. Mortgages are based on a 10-year treasury. I think we start to see further yield curve inversion and mortgage rates come down somewhat from where they are now, simply because that yield curve is going to continue to get inverted. I don't see this changing in terms of, even though I'd say the 30-year mortgage rate could probably drop a little from where we are, I don't think that'll stem the housing trend, because what you have is a multiplier effect from the housing market that bleeds to the rest of the economy. So as this industry slows dramatically, it's going to further deepen the recession we are entering. So I don't think good things are to come for the housing market. However, if you're looking for some bargain prices, you probably get a better deal 6 to 9 months from now than you will today. But it's already reversed itself, and now that the average home, according to Redfin, is selling below ask, it's the first time that's happened in a couple years. So definitely the tide has turned for very much the worse in the housing market.
Right. And let me just point out, and I've said this before, the Federal Reserve created another housing bubble. and now they're going to have to manage its collapse. And when you have a precariously, dangerously over-leveraged economy, or industries, it does not take much of an increase in interest rates to send the dominoes toppling. And look no further, Mike, this is a jump ball for you. This is a front page story in the Wall Street Journal today that junk loan defaults are beginning to worry investors. That defaults on leveraged loans hit $6 billion in August, the highest monthly total since October of 2020. And I know Stephanie Pomboy has talked about the danger of junk, but this is just one of the dominoes beginning to topple.
Yeah, I'd expect credit spreads to widen out further, and you're going to start to see a lot more defaults. But this is how the Fed causes a recession. You increase the cost to borrow an over-levered company, and that increasing of cost to borrow not only slows the economy, it causes over-levered companies to default. This is something that we skipped over in the recession of 2020 during COVID because the Fed stepped in to buy junk bonds. I don't see them doing that this time around. Some sort of reorganization for credit, that's not necessarily the worst thing in the world, to take out some of these over-levered companies and clean up. I don't know if I call it garbage, but for reorganize. So I don't know if that's the worst thing in the long run, but definitely going to lead to some short-term pain.
Thank you so much, Michael Lee. You sit right there. Rebecca Walser, great to see you as well. Thank you again. Coming up.